This is Andrew Stotz of Stotz Investment Research. And let me turn off my air conditioning first. That'll get a little loud. I'm going to talk to you about the top 9 valuation mistakes and how to avoid them. Now, this video is on mistake number 6, understanding working capital investment. So the top 9 valuation mistakes are: number 1, overly optimistic revenue forecast. Number 2, underestimating expenses causing unrealistic profits. Number 3, growing fixed assets slower than revenue. Number 4, confusing growth capex with maintenance capex. Number 5, forecasting drastic changes in the cash conversion cycle. Number 6, underestimating working capital investment. Number 7, valuing a stock using the calculated beta. Number 8, choosing an unreasonable cost of equity. And number 9, not properly fading return on invested capital. So let's talk about number 6, underestimating working capital investment. So why is it important? Well, net working capital from a valuation perspective versus an accounting perspective is what I want to look at. Valuation uses changes in free cash flow. In valuation, we exclude cash and short-term borrowings from net working capital because they're accounted for later in the valuation process. Net working capital is difficult to forecast because it's a result of 5 different forecasts: accounts receivable, inventory, other current assets, accounts payable, other current liabilities. So let's look at those items for a moment just to understand. This is a study I did of all companies basically listed in the world. It's 17,000, which is a good enough sample to say that represents all companies. So we can get an idea of current assets are about 35% of total assets. So 35, if total assets were 100, 35 would be allocated to current assets. And 27.7% is the amount of current liabilities relative to total assets. So let's look at free cash flow and the general concept of how we calculate it. First, we start with net operating profit after taxes. We add back depreciation, and this is what I call basic cash flow. That's usually an inflow of cash, obviously a positive number. Next, we take away 2 different items. This is the investment in capex and the investment in working capital. Those 2 combine is what I call total investment, and this is usually a cash outflow. You'll see that what I like to do is I like to look at the change in the investment in working capital as just about the same as the capex because we need it. So free cash flow to the firm is the result of that. So net working capital reduces free cash flow but supports growth. In valuation, think of the change in net working capital as an investment, just like investment in fixed assets. Usually it's a cash outflow and therefore reduces the free cash flow. So let's take a look at working capital for a moment. We could say that working capital in the traditional sense is the amount of current assets that we have. That's the working capital minus current liabilities, in this case 27.7. We end up with net working capital. So that's kind of the traditional accounting perspective. But if we look at the way that we look at it in the case of finance and free cash flow calculation, well, we remove the cash and short-term investments and we remove the overdrafts. That leaves us with accounts receivables, inventories, other current assets, and then accounts payable and other current liabilities are the liability side of that. So if we look at that amount, in this particular case, we've added up accounts receivable, inventories, and we go through all of that, and what we can see is -1. So now let's take a look at how we get to this. So first of all, I take the balance sheet of a company here, and let's just say that we look at the accounts receivable, and we can see that the accounts receivable increase from 7309 to 7486. An increase in an asset means that you're using cash, and therefore it's a negative item. We can see below 178 minus 178. And if we add these up, we can get to the bottom, change in net working capital, which is 210 and 184. Those are positive items in those years, but in prior years, they're negative items. So it's the change in working capital that matters for forecasting in valuation. So now let's just look at this data across all companies, and we can see that change in net fixed assets, well, that's always a negative, almost always. We see 2016 as an exception to that. But for almost all years, basically the change in net fixed assets, or sometimes we can call that capex. I'm looking at change in net fixed assets specifically here. When we see that, usually that's an investment amount. But the change in net working capital can be positive, negative. It's a smaller item, but it's volatile. So how to avoid the common mistakes? Well, review the company's prior trend in net working capital. Does your forecast fit that general trend? Like look at company A. It's got negative, negative, negative for the 3 past years. And then would a forecast of positive, positive, positive make sense? Unlikely. And there's company B with a positive, positive, positive. Would a negative, negative, negative make sense? Probably unlikely. So when forecasting deviations from that trend, have a strong reason and tell that story. Nothing wrong with having a change or a difference from the past. What a great opportunity to tell the story that you're seeing. So what have you learned? Unlike in accounting and valuation, we exclude cash and short-term borrowings from net working capital. Changes in net working capital are volatile because that change results from 5 separate forecasts. Net working capital is a small but volatile investment item. And finally, large deviations from past trends usually are a mistake. But if it's not, explain it carefully. So that wraps up number 6. Next, we're going to look at valuing a stock using the calculated beta, number 7. I'll see you there.